Could I just get confirmation that you can hear me in the chat from somebody, please? If not, I'm going to assume that I'm being heard if the microphone is working. It should be working. Just hello. Okay. There. So I'm just going to get into your webinar. This is finance. Mainly, we're going to go into corporate finance. But I will just get right into it then. So let me. There we go. Okay, so finance, your webinar with me, Simarbir Singh Gill. Agenda today, we're just going to cover a brief overview of a basic idea of finance, the forms that a business can take, because we're mainly going into corporate finance, financial statements and measuring a company's financial health with different ratios, and briefly some financial models that you can put into Excel, for example. So what is finance? Well, finance in a general sense is the management of money and activities such as investing, borrowing, lending, budgeting, saving, and forecasting. And the three main types are personal, corporation or corporate, and public/government. So when you think of personal, right, that's your own individual tax returns and usage of credit, investments, buying a home, insurance, etc. Corporation, we're going to get into throughout this webinar, and government really is just like tax collecting, borrowing money, what the government's going to do with the taxes, etc. Also, forgot to mention, but if you have a question, if you can unmute, I guess you can ask, or if you have it, you can put it in the chat as well, and I'll be checking that. So that basically ideas of what finance is. Now, if we look at this Corporate Finance Institute career map, we see a bunch of different examples of career sectors that you could have with finance. And some of them we'll be talking about later, like valuations is a good one that we'll be mentioning later with public accounting. But for example, with banks, you'll go into things like equity research to help portfolio managers make better informed investment decisions, investment banking as well. You could have FP&A analysts with corporations to consider economic and business trends or look at company performance to anticipate problems in the future, for example. You could go into portfolio management, private equity with institutions managing a set of different investments, like, for example, any kind of like education fund or hedge fund, mutual fund, etc. Now, we're going to get into the forms of business first. So, one of the first things you need to consider is um, how the business is going to be structured, because all businesses have to have some legal configuration to define their rights and liabilities, and as well as control, ownership, lifespan, financial structure. And so this decision is going to be pretty important for the future of your business, and it's important to probably consult an accountant or attorney to help you with this. So the business structure is going to affect how much you pay in taxes, the ability to raise profits, paperwork, and personal liability. And the four main types are sole proprietorship, partnerships, corporations, and limited liability companies. And within some of those, there's subcategories, etc. So these are just the basic overviews of what they mean. Sole proprietorship is firms owned by one individual who's usually running it day to day. A partnership is two or more people sharing ownership of a business. Corporations are going to be chartered by the state that they're headquartered in, and they're a unique entity separate from the owners. And a limited liability company, or LLC, they're flexible. They have aspects of corporations and partnerships, and there's certain rules, regulations with it. So when you're creating a business, you want to envision what level of control you want to have, the level of structure you can deal with, the vulnerability to lawsuits, tax implications, and certain deductions you can make. And so with these four types, sole proprietorship is a good one. Um, a lot of small businesses actually start out of this. It's typically a person who's in charge day to day is the main owner of the business, and they own all the assets, the profits generated, but they also have to take control and assume responsibility for all liabilities and debts. Liabilities just being like loans, debts, any like expenses, and so in the eyes of the law, they do not distinguish the business from the owner. So any taxing or anything is going to go to you, which will be different later on with different models, different forms. So some of the advantages with sole proprietorships, they are easy. They're the least expensive of any of the four main forms of a business. You have complete control of the business within the parameters of the law, of course. Um, the profits are going to be flowing through directly to the owner's personal tax return, excuse me. And if you need to dissolve the business for whatever means, it's easy to dissolve. But some of the cons that you'll see with this whole proprietorship are that you have unlimited liability and are legally responsible for all debts. So any assets in the business, they're going to be at risk because it all goes back to one person. Only one person's dealing with it. You could also be at a disadvantage and face risks in raising funds, or you are limited to what funds you can use, such as sometimes you might have to use your own personal savings or your consumer loans. And you might have a hard time attracting some high caliber employees or people motivated to own a part of the business. And some benefits are not going to be directly deductible from your business income. It only will be partially as just an adjustment to your income. Now, the next form of business is partnerships. In a partnership, it's two or more people who are sharing ownership. They have to agree on several factors in the legal agreement to how decisions will be made, profits being shared, how disputes are going to be resolved, how future partners are going to be admitted, how they can be bought out, or what steps it will have to take to dissolve. And like a sole proprietorship, the partnership does not actually distinguish the business from the owner as well. And so, um, some of the advantages, pros of a partnership, they're pretty easy to establish, although it is noted that you should definitely spend time on your agreement to make sure you have the proper things settled, proper uh, layout that you want to have with your business. And there's an ability to the ability to raise funds may be increased with having more than one owner of your business. The profits from the business flow directly through to the partners' personal tax returns, and prospective employees could be attracted if they're given the incentive to actually become a partner. So that kind of ties into personal finance a bit, where if you have an incentive to actually work, then that's definitely a good thing to have. And that's what a partnership will often do with corporate finance. And the business is usually going to benefit from partners who have complementary skills. But some of the cons of having a partnership: partners are jointly and individually liable for the actions of the other partners. So they together and separately have to deal with any liability or debt or anything as a cause of the other partners. Profits have to be shared among each other. So because decisions and profits are being shared with these legal agreements at the beginning of forming the partnership, you could also see a lot of disagreements among shared decisions. Some employee benefits are also not deductible here as well, and the partnership might have a limited life. It may end upon the withdrawal or death of a partner. So there's some subcategories of partnerships. You have general partnerships where partners divide the responsibility and the liability, the shares of profit, and equal shares are assumed unless there's a written agreement that'll state differently. You have the limited partnership, or a partnership with limited liability. So limited just means that the partners are only liable to the extent of how much they invest in the company. So if something goes wrong, it's not going to affect you too much. It's just based on how much you actually invested, and that'll apply for the limited liability company as well. So it generally encourages investors for short term projects or to invest in capital assets. And this form of ownership is not often used for retail or service businesses because it's more complex and formal than a general partnership. and you have a joint venture as well. It acts like a general partnership, but it's clearly just for a limited period of time or a single project. And if the partners repeat the activity, they'll be seen as an ongoing partnership and distribute partnership assets upon the dissolution of the entity. And so, next business form is a corporation. A corporation, they have to be chartered by the state that it's headquartered in because it's considered by law to be its own unique entity. It's actually considered separate from those who own it. So with the um, with the sole proprietorship and with partnerships, the business was inseparable from the owners, but here they're two distinctive beings. And that means that your corporation can be taxed, sued, enter agreements. The owners are the shareholders. And so the owners, they end up selling shares of the company in form of common stock, which equity ownership or a type of security that allows voting rights to anyone who owns it. And so these shareholders are electing a board of directors with the company, and that's going to allow them to uh, decide on major policies and decisions. And since the corporation has a life of its own, if ownership dies out, then the company is not going to die out in return. Now, some of the pros with corporations: shareholders have limited liability for their debts or judgments against the corporation because, again, it's shareholders on an elected board, so it's only to the extent of their investment. Um, Generally, shareholders can only be held accountable for their investment in the stock of the company. The same thing there. Uh, Corporations can raise additional funds through the sale of stock and common stock. It can also deduct the cost of benefits for employees and officers. And they can also elect something called S corporation status, which I'll get into on the next slide. Some of the cons that you see with the corporation are that the process of incorporation is going to require significant time and money compared to a sole proprietorship or a partnership. And corporations are monitored by federal, state, and local agencies. So you may have more paperwork to comply with and more regulations compared to, say, sole proprietorship, where you have complete control as long as it's in the jurisdiction of the law. And incorporating could result in higher overall taxes, and the dividends that you pay to shareholders who own the stock, they're not deductible from the business income. So that income can actually be taxed twice. So now, last form of business. Oh, wait, sorry. Subchapter S corporation is actually next. The subchapter S corporation is a tax election from a standard corporation. The shareholders are going to treat the earnings and profits as distributions, but they're going to be taxed as a result like a partnership. So if the shareholder works for the company making and the company making profit, then they have to give themselves reasonable compensation. So the rule of thumb is that you just give yourself the wages, the salary of what you would pay someone who's doing that job if it wasn't you. And with subchapter S corporations, you're having tax savings. You have to meet the IRS requirements, of course, or else the IRS could easily audit you. Reasonable salary for yourself and just profit being distributed among the shareholders. So that only happens if you meet certain requirements under the IRS. Then you can elect your corporation to be a subchapter S corporation. And now, limited liability companies, they are designed to provide limited liability features from a corporation, which, like, shareholders being only responsible to the extent of their investment. And they also provide tax efficiencies and the operational flexibility of the partnership and so proprietorship. Um, so the duration is determined when you file the papers for the LLC, and it cannot have two or more of a corporation's forward defining features, because if it has three or four of those features, then it has to be taxed as a corporation by the government, by IRS. So must not have two of the four corporation defining features. It can't have, well, it should have at least limited liability to the extent of assets. Continuity of life's another feature. The idea that if the ownership dies out and the company will still live on with the corporation. Having centralized management with that board of directors and free transferability of ownership interest, tying back into the idea of continuity of life. So some of the benefits you see with LLCs, your personal assets are going to be protected in the case of a legal dispute much more securely than other businesses, especially like sole proprietorships. No other businesses in the state can use your name, so uniqueness. Fewer requirements than a corporation formally, with of course the exception being that you have to have only two of these four requirements right here, and tax flexibility to be taxed as a sole proprietorship or a partnership if you so choose with your business. So, comparing an LLC to a corporation, the corporation is a lot more formal in its management structure, but the LLC in comparison is a lot more simple. There's less paperwork with the LLC because there's no meeting requirements. But what you see with the corporation, again, is just that since everything is being monitored by federal, state, and local agencies, there's a lot more paperwork, and um, they also have the ability to raise capital by issuing stock much more to a greater extent than an LLC when you have a corporation. But the LLC doesn't have to face double taxation on salaries because the business income isn't being taxed twice, whereas with a corporation it is. But the corporation has tax deductible fringe benefits for the employees and officers. Ownership is represented through stock for the corporation, but with the LLC, it's distributing ownership freely. So now we're going to get into financial statements, and these are written records that um, convey business activities and how a company performs financially. And these are going to be used by investors, market analysts, creditors, etc., in order to actually evaluate a company's financial health. And that's basically just the current state of your company situation, your credit, your debt, savings, investment, income. It's going Investors and market analysts, creditors, they're all going to be analyzing all of these different aspects across the three main types of balance sheets, or three main types of statements: the balance sheet, the income statement, and the cash flow statement. And what we're going to see later is that they can also be linked in certain ways, especially through Excel. And with that linking, it's going to be more simple to analyze, although it always is going to be complex, but you can see how everything lines up. So, financial statements are often audited by government agencies, accountants, firms to ensure accuracy as well, and for tax, financing, and investing purposes. So, going into the first one, we have the balance sheet. The balance sheet is an overview of your assets, liabilities, and your shareholders' equity. And the important part is that this is on a specific date. So it's only like a snapshot of time when you have your balance sheet. And so assets, basically just the things you own that have value, like cash and cash equivalents, accounts receivable, the amount of money owned to a company, in your inventory in general. And then your liabilities are expenses or dividends you have to pay, wages, your debts. So this is going to provide the this is going to show what the company is worth from a book value perspective. Um, and what you're going to see is that this assets for the balance sheet, it's equivalent to your liabilities plus your equity for the sheet in order to balance. You need to have liabilities and stockholders' equity equivalent to assets if you want to truly balance your balance sheet. And the book value divided by or the book value slash equity is just equal to your assets minus your liability. So if you take the things you have value and you subtract it from your expenses, your debts, etc., then your equity will be a number that, when added to your liabilities, will be equivalent to those assets. It just makes sense. And then it's neither solvent or insolvent. The balance sheet needs to balance. So assets being greater than liabilities can't be solvent, but if liabilities greater than assets, it would be insolvent, but it shouldn't be either of those because the company is trying to balance the sheet. And so analysts, they typically judge the long-term assets of your company, and with a comprehensive analysis of the balance sheet, uh, you're going to have several ratios that analysts use, that will be on the next couple slides. You're basically identifying how much debt the company has relative to its equity, how liquid, or like the ability to get your money into cash, tangible cash, how fast you can do that. How liquid is it in the short term, usually less than a year? What percentage of the assets are tangible, and what percentage comes from financial transactions, how long it'll take you to receive outstanding payments from customers and repay suppliers, and how long it takes to sell inventory that the business keeps on hand. And looking at some of these ratios, um, and also looking at an example of the balance sheet soon, we have these ratios that you're going to see a company's efficiency and their financial health through, and that's what several analysts use. So the five that I have are the asset turnover ratio, your receivables, your accounts receivables turnover ratio, debt to assets, debt to equity, and the quick ratio. So asset turnover ratio, it's measuring the efficiency of a company's assets to generate revenue or sales. So it's going to compare the revenues, the total net amount of sales, to the total assets, the average amount of total assets in a yearly percentage. And you divide the net sales by the assets. That's going to give you your asset turnover ratio to determine the efficiency in generating revenue. Now, accounts receivable turnover ratio, you're you're measuring the efficiency of a company to collect on its receivables or the credit it extends to customers. So it's measuring how many times the accounts receivable is converted to cash. It's measuring liquidity in a sense. So net credit sales divided by the average accounts receivable for that one. The debt to asset ratio formula, you divide your total debts by the assets. It's a type of leverage ratio to compare a company's debt obligations to their assets. And that'll be key to seeing the company's financial health as well, because you don't want more debts than assets. Your debt to equity ratio, you're dividing the liabilities by the equities, their total equity. And with this ratio, you're going to see that it's comparing the debt obligations, their financial leverage of the liabilities to shareholder equity. And this is one of the more important ratios for the company's financial health. And then the quick ratio. The quick ratio indicates the company's short term liquidity position, and it's going to measure a company's ability to meet short term obligations with its most liquid assets. So it's indicating the company's ability to instantly use the near cash assets, the assets that you can convert quickly to cash, the liquid assets, to pay down its current liabilities. And so you want, obviously, the current assets minus inventory to be a substantial amount, um, compared to your current liabilities. And that is that for the ratios. So just to go back a couple slides, going to look at this consolidated balance sheet. And we're going to see that your total assets right here, 338, so it's in millions of dollars. So your total assets here are 338.9 billion, because it says here in millions of dollars, and that's this year's, the previous year, so you can compare the years here, all the assets for this company. Then liabilities, you see that it's 163.2 billion. And if you look at the shareholder equity with all of these costs, you're going to see that it is 175.7 billion. And if you add all these up, we see that it reaches 338.9 billion for the total liabilities and equity added together. Your assets are then equal to liability plus equity, and that means that this sheet is balanced and the company is financially healthy. Next statement is your income statement. Income statements, they provide details on the revenues, expenses, net income, earnings per share, and it's in comparison to a balance sheet. The balance sheet is just a specific snapshot of time. This is over a long range of time, not necessarily like too long, but it's over a long range of time. It's not just on one specific day. Like the previous one, you saw it on December 31st. This one, the entire years. And it's going to provide more granular data on the operating activities of the company to show direct, indirect, and capital expenses. So these include your costs of goods sold, your sales, salaries, generals and administrative expenses, and other sorts of expenses like depreciation, research and development. They're going to be subtracted from your gross profit, and with your direct expenses, the cost of sales are going to be subtracted from revenue to actually reach gross profit. So direct expenses, you achieve gross profit, then you're going to subtract indirect expenses from that. Then your capital expenses are your interest, tax, extraordinary items, and you subtract these from the gross profit, and that's going to help you reach your net income. Or the total amount of earnings a company has achieved after subtracting all of its liabilities and expenses. And so the analysts are going to look here with an income statement to see the profitability of of a company through several ratios as well. So actually, example first. The example here is ExxonMobil's statement for the fiscal year of 2021. And we can see here that your total revenue is around 276.7 billion is what it's going to be, because you have kind of like because your total revenue is that, and then other income doesn't include that. So we're mainly just looking at sales and operating revenue here. And then you're going to look at your total added costs for deductions and expenses, indirect expenses. And so that'll be 254.4 billion. Your net income and your profit after all of these and deductions, etc., it'll be 23,000. Well, it'll be 23 billion, but and so that's how the income sheet kind of works. And you see over a long range of time, it's over uh, three 3 year span fiscally, and that's how they're going to look at it with different ratios, with different numbers for the profitability. So these ratios are going to provide intel on the company's financial health and profitability, the gross margin, operating margin, and net margin. And there are more, but these are just a few that I will get into for today. So here are your different formulas for it. Your gross profit margin ratio, that's usually like going to be showing how much profit the company makes after paying off the cost of goods sold. So that's after the direct expenses. And it's going to indicate the percentage of each dollar of revenue that a company retains as its gross profit. Then you have your operating profit ratio. It's going to show the cash received from making sales as part of company operations during the fiscal year or the quarter. And it'll also show operating cash outflows spent to make those sales. So is going to be like the cash paid for rent or salaries or administrations. Then you have your net profit margin ratio, right? Net income after all of your indirect expenses, capital expenses are subtracted from the gross profit. That's just basically the percentage of net income that you receive with each net sale. And so now getting into the last statement for financials, you have the cash flow statement. So the cash flow statement basically just measures how well companies generate cash. So it's another measure of liquidity to pay off your debts, fund operating expenses, fund investments, etc. And so there are three parts of this: your operating expenses, investing expense or operating activities, excuse me, investing activities, and your financing activities. So operating activities just includes cash from operations, including any changes made in cash, accounts receivable, depreciation, your inventory, your accounts payable. Investing activities is purchasing assets, making loans to vendors, or receiving loans, and any payments relating to mergers, acquisitions, consolidations of businesses, and financing activities, um, debt issuance, equity issuance, repurchasing stock, your loans, paying off dividends, repaying debt. So, kind of different aspects that we were already talking about, especially with the different forms of business. Now, if we look here, this is ExxonMobil's cash flow statement for the fiscal year of 2021. As you see, like the income statement, it was over a period of time, not just one specific day on one specific year. And we can see that operating activities, it's a total of 48 billion that is generated. This is a positive cash flow because cash is flowing. These are all liquid. Your operating activities are all liquid here, and that leads to 48 billion. Then you have investing activities, but they're going to generate negative cash flow, which is why it's in parentheses, because that's signifying that it is negative cash flow from all of the expenses here, from your investments. And so that means that you're going to have to subtract it. And then financing activities also generating a negative cash flow of 35 billion in the fiscal year of 2021, with the different dividends that had to be paid, change in non-controlling interest, common stock, different debts. And that's basically how you are reading a cash flow statement. And it's going to actually complement your balance and income statement. It's just reporting cash inflows, cash outflows. That's the simple way to look at it. There are no ratios there, but limitations that you have with your financial statements as an analyst in general, um, differing conclusions. You can gain an incorrect view or of the cash flows or the financial results by looking at only one reporting period, and any one period could vary from the normal operating results, maybe due to sudden spikes in sales, whether it be uh, certain aspects outside of the market that cause it, like, for example, that whole GameStop boom from like 2020 for no reason in the stock and whatever, because the app was broken, I believe. And that's kind of one of those non-market risks that you would deal with differing conclusions that can affect your financial statements. And it's just covering a specific period of time. You just want to have a greater idea of how has the company been performing over several different years. And sometimes they're just not comparable as well. Like, financial statements are not always comparable if entities use different accounting practices and different types of operating or financing investment activities. And so sometimes the companies just, it's not a good measure to judge financial health in comparison to other countries, or excuse me, companies, um, with the use of these financial statements. um, then historic costs, not predictive results. It's all just historic results, financial status of a business as of a specific date, but they don't really help you in predicting anything that could happen in the future and making assumptions on how the company is going to do in the future. No sales the next month. So, say the business reports really great results, excellent results in one month, then the next month it's a very steep decline. And that's just what you see with financial statements, that it can be tough to judge financial health of a company if things can change so drastically. And going back to differing conclusions, you could also very easily have fraud if the management team of a company deliberately tries to skew the results that are presented through your different income statements, cash flow statements, balance sheets. The situation arises if there's undue pressure to report excellent results. And so companies could very well just spit out fraudulent financial statements, and one could think, oh well, the company is doing well, then there's a reason for this spike to exceed the norm, and a reason for everything if it's well above their trend line. And it could be tough to judge their financial health if it's so abnormal. So With financial statements, you have several financial models that you can that you can use, especially in Excel. And these financial models are going to allow you to track and analyze the financial health of the company and also just link the three statements together. So we have the three statement model, the discount cash flow model, the merger model, the initial public offering model, and the leverage buyout operating model. So three statement model. The three statement model is the basic setup for financial modeling. So the name implies it's just linking your three statements: income statement, cash flow statement, and balance sheet, linking them all together with formulas dynamically in Excel. So you want to set it up so that every account, they're all going to be connected. You know, a set of assumptions can drive changes to in the entire model. Excuse me. So with the three statement model, it's important to know how you link the three financial statements. And so that's the process listed out on the left. You're looking at accounting principles, the net income and retained earnings, work capital, financing, and cash balance. Um, in financial modeling, you want to link all of these together. So when you have your accounting principles, the creation of the balance sheet through accounting principles such as revenue recognition, matching, it makes the income statement different from the cash flow statement, and it just leads to the balance statement, which in turn will lead to the rise of the cash flow statement. Your net income on the bottom of the income statement, that is linking the balance sheet and the cash flow statement. On the balance sheet, it's going to feed into the retained earnings. And on the cash flow statement, it's the start for the cash from operations section. Now, depreciation, other capital expenses, this is related to your work capital or the income statement. On the income statement, need to be added back to the net income to calculate the cash flow from operations. And depreciation is going to flow from the balance sheet onto the income statement as an expense, and then it'll get added back to the cash flow statement. Financing, the interest expense is going to appear on the income statement. The principal amount of debt that is owed is going to sit on the balance sheet, and then the change in the principal amount owed is going to be reflected on the cash from the financing section, the financing activity section of the cash flow statement. And then the last step to linking them is your cash balance. Once you link together the accounting principles, the net income and retained earnings, work capital, and financing of the different statements, then you are going to look at the sum of the cash from the operations, the cash from investing activities, and from financing activities. They're going to be added up together to the prior period's closing cash balance, and then that'll be the current fiscal year's closing cash balance on the balance sheet. The discount cash flow model, it's going to build on the three statement model, and it's going to value a company based on net present value of the business future cash flow. So just what is the value of the company at the current point in time after you subtract all expenses, etc., from its cash flow. This model takes the cash flows from the three statement model and it makes some adjustments where necessary. And it's going to use something called the XNPV function on Excel. Now, this function just looks at rates, cash flows, and it looks at the date of the cash flows. And so you see here with that Excel sheet right there, looking at all the dates, values, rates. That's the main components of your XNPV, which it's your net present value of an investment for payments or incomes at irregular intervals. And the XNPV is used to calculate the NPV. Excuse me. And the payments or incomes do not need to occur at regular intervals for calculating your XNPV. Now, the merger, also consolidation models, it's a more advanced model that is used to evaluate pro forma accretion or dilution. And what this means is just your earnings per share. So, how much are you making for each share that you hold in the company itself? If is increasing, then that's accretion. If it's decreasing, then it's dilution. And mergers, just simply using mostly single tab models for the company, the consolidate one company or more, or two companies or more into one merged company. And this was like a very substantial model throughout US history, even seeing it in like the Gilded Age, for example, and trusts, and very common today as well. It can vary in the level of complexity, and it's mostly used in investment banking or corporate development. So the process of this begins with estimating your pro forma net income with your earnings per share. And we're going to look at how to build a merger model. Well, first thing you need to do, making acquisition assumptions. So if someone who's buying your company's stock, if the stock is undervalued, they may decide to use cash instead of equity consideration, um, since they would be forced to give up a lot of shares to the company. But if the company wants to receive income because it might be more valuable than cash, then they find an agreement, um, considerable to both parties, that'll strike a deal. And that's kind of helping with making assumptions, because in order to forecast after this, an analyst will make assumptions about revenue growth, margins, fixed costs, variable costs, capital structure, capital expenditures, and all the other accounts on the company's financial statements. And that's linking those two. Now, valuation, it was something we talked about way long ago with the career map and one of the parts of the public accounting sector. Valuation of a business is looking at the discount cash flow model, the looking at this model and see that it is compared and contrasted against the comparable company analysis and precedent transactions. Cash flow generated from the business is discounted back to a specific point in time, which is why this is called the discount cash flow model. And um, that's for a variety of reasons. But with this, that's going to help you evaluate a company. Uh, Business combination and pro forma adjustments, that's simply just the merging of the many different companies, A and B, or however other companies you are merging into this merged company. And your pro forma adjustments, which leads into deal accretion and dilution when you're calculating earnings per share and net income. And so the net result of this, or excuse me, actually, the net result of your discount cash flow, which I forgot to mention, is the firm's weighted average cost of capital, with your net present value, and That's the required rate of return that investors expect you to give back. But for a merger, this whole process is basically it for making the model in general. Then the initial public offering. So an initial public offering in general is when a private owned company, our enterprise, is turned into a public company. They sell their shares of stock on the public market. And so people out in the public are able to actually be shareholders for the company. Investment bankers and corporate development professionals build IPO models in Excel to value their business in advance of going public. So the model that you're creating on Excel here is to help you make an assumption while also comparing yourself to other similar companies. And that's going to help you decide how much it's going to help if you do go public, from a private company to public, how much investors are going to pay for the company in question. And obviously, IPOs are great for a company just to get investments for different expenditures and expenses that they want to go after as a company. And so the valuation in an IPO model, looking back at discount cash flow, it'll have an IPO discount, so a further discount to the discount cash flow, to ensure that the stocks will trade well in the secondary public market. And so see with these models that a lot of them do actually go back to discount cash flow. So it's very important to know this and very important to know the XNPV function as well. If you were ever going into a financial career and you wanted to, would definitely have to be proficient in Excel, especially with all these different models that you could be tasked to help create. And so the final model here is your leveraged buyout model, the acquisition of a company using a significant amount of debt. That is what a leveraged buyout is. And the transaction it requires modeling a lot of complicated debt schedules. And so this is a very advanced form of financial modeling. It's often one of the most detailed or challenging of all the types of the financial models that you'll put on Excel. And as the many layers of financing create different references, cash flow, they're not going to be very common outside of private equity firms or investment banking. And that is really it. But there are other financial models that I will briefly go over. They're not on the slides, but you have the sum of parts model. It's a model that is built with several discount cash flow models, um, and you add them all up together. And then you add additional components of a business that might not be suitable for discount cash flow analysis, like marketable securities, what your value would be for shares based on the market. And that's not something you will see here because this just really compares your dates, the values, and the rate. And going back into similar idea with the merger model, you have the consolidation model, taking multiple businesses added into one single model. You have the budget model as well, which if we go back all the way to the career map, going all the way back to the career map, you will see um, that we're looking at FP&A analysts, and the budget model is mainly what they use to model finance because it's getting the budget together for the coming years, and it's typically designed on monthly or quarterly figures. And remember that FP&A analysts are the ones who oversee a very wide array of financial affairs like income, expense, taxes, capital expenditures, investments, financial statements. So, because of this, they're analyzing those business trends, and that's why they need to help with the with the budget model in order to design a budget focusing heavily on the income statement. And going back into them again, the forecasting model is another model you'll see on Excel. And with the FP&A analysts, you're going to build a forecast to compare to the budget model. So those two actually go hand in hand there. Um, they're one combined workbook sometimes, sometimes they're completely separate. But the point is that you have the two. Oh, I'm freezing. Well, the internet has been a bit iffy here. Um, if you need me to repeat anything, please let me know because I'm not sure when would have been freezing. Um, but anyways, that's really it that I have for you. But unless you, okay, all right. If you need anything repeated at all, just please let me know because I apologize for that inconvenience with the freezing earlier. Um, but that is all that this slideshow entails. So just basically what we went over in short was why is it not? What we went over in short was corporate finance and um, the ideas of what financial statements are, different forms of a business, your four different main forms, measuring the company's financial health with your different ratios, especially with the balance sheet and some with the income statement, and linking those financial statements as well as in comparison to other jobs on the career map. like in general, finance is a very big web. You connect the financial models to the financial statements, which impact your forms of business. And that's basically all that finance entails for this webinar. So if you have any questions, feel free to ask, or in the chat if you want to, if you can unmute. I don't know how this big marker works, but um, if you don't have anything else, it is a bit early, but I would say you're free to go. So thank you all for being a good audience. If you could still, yeah. Thank you all for being a good audience. Thank you for coming out today to pay attention to this webinar. The 4 forms of business. Okay, so basically what you want to think about with the 4 forms of business is sole proprietorship. It's just one person who's in charge of everything. They're responsible for everything that goes against the company, but they're also responsible for all the positives that you see with the company, right? Let me just go to the, yeah, so why is it not? Okay. Yeah. So sole proprietorship, it's less expensive and you have a lot of control. You have full control as long as you are, you know, in the jurisdiction of the law. And with sole proprietorships and partnerships, they are not distinguished between business and owner. So only the owner is getting taxed. With corporations, the unique entities. Um, with partnerships, it's 2 or more people in an agreement. So they have to decide together as partners. They have to distribute how profits are shared, resolving debts, etc. So the it's less control for each person because they're all joint decisions. And then corporations are even further than that because the corporation, it's just the owners are shareholders who own stock that elect the board to make decisions. It's different from the owner, and the corporation itself are considered different legally. So um, with them, you'll see that shareholders have limited liability. With these two, you don't really have as much limited, or sole proprietorship doesn't have limited liability. So if you want to think about it, sole proprietorship, one person in charge of everything, not really having limited liability. Partnership, 2 or more people together, they make joint decisions and they have a greater ability to raise funds. A corporation is a corporation is a business that's considered separate from its owners, so it can be treated like a person, and their shareholders are the ones in charge, and corporations have some limited liability. And limited liability companies, they just incorporate features of the partnerships and of the corporations. It's obviously you are only at risk to the extent of your investments, but you also have other benefits as well. So just think of it like that. One person, 2 or more people, shareholders, and separate from the owners, and then basically like a hybrid model of partnership and corporation. So I hope that answered your question. Let me stop screen sharing. Yeah, if there are no further questions, then I will end. Well, thank you for asking the question, of course, and thank you guys once again for coming out today, and I hope you did learn well. So, yep, have a great day, you too.